So in the yield to maturity calculation, you need to calculate the value on an annual basis. And if you're buying it cheaper, you will add the extra amount. If you're buying it expensive, you'll minus the extra amount. Okay, so do a few calculations of those and then that should be more clear. Okay, and then these calculations are, so those were from chapter 7, right? So now the next ones are for chapter 8. So do you think, should we go back to theory and finish up chapter 9 and then come back to the calculations? Is that okay?
Yeah, that's fine.
Yeah, let's go back. So we'll do the rest later on today or tomorrow. The other ones are, you already have this link. You can also work on them on yourself, and I will also add more questions there. But yeah, let's come back to the course here. I'm going to open up the slides and we can continue with, let's do um, chapter number 9, understanding financial statements. Okay, so we're going to do that. Okay, so let me share my screen here.
Are you okay to send the worksheet
Yeah,
on email as well? Okay,
yes,
perfect.
I will send it to you. Yes, yes, no
I can
problem. Yeah, I'm going to
practice
send it to you
today.
guys as soon as we're done. Yeah, no problem. Yeah, I'm going to send it as a Word document so you have that available. Okay, chapter number 9. Okay, sorry, let me bring the other one up. Full one. Okay, chapter number 9. So here we're talking about overall the financial statements, so you should understand how they work.
Sorry,
Okay,
we
so,
can't see the screen. Like,
oh, okay, let me share. Okay, do you see it now?
yes.
Okay. All right, so there are 4 financial statements. So in your course, they have 3, but actually there are 4. But we're not talking about the fourth one here. So we're just going to talk about the 3. There's financial statement, a statement of financial position, comprehensive income, and changes in equity. So let's talk about these. The first one is, so why are we doing this? We're saying, okay, if you're investing in a company, you want to know about the company. What are their assets? What are their liabilities? And what are their equity? By assets, we mean what is the value of um, their assets include, of course, their equipment, plant, land, machinery, other stuff. So we'll talk about, there's 2 main types. There's current assets and fixed assets. So these are the type of things we want to know. What is the value of the company? Liability is, what are their loans? What loans do they have to pay within a year? And what are their long-term loans? And then equity is the shareholders' interest in the company. So that is the equity. So the basic formula you have to remember is that equity plus liability is equal to assets. So that is, if you think about a house, think there's a house worth 700,000. Let's suppose the mortgage on it is 200,000. So the equity which is in the house is 500,000. So 700 minus 200 is equal to 500, or 500 plus 200 is equal to 700. So this is the basic formula we use. Same thing for the statement of financial position for the company, right? Clear? So we're going to talk a little more about the assets and liabilities. So, so we said assets and liability, the difference between the two is the shareholders' equity or net worth. That is the, so this here we just said here, the difference between, if you do assets minus liability, So 700 minus 200 is equal to 500, right? So that is what we're saying here. Now under assets, we said there's current assets and there's fixed assets. Current assets is cash. Anything which is cash is a current asset. Anything which is expected to be converted to cash is also, for example, if you have finished product in the warehouse and you expect to sell it within this year, it is considered as a current asset. And if you have a trade receivable means you have already sold your product, but you have not got the payment yet for it. So let's suppose it's the year end in December 30th or December 15th, you send out a shipment to a company and they sold your product, but you did not yet receive that money. So that is a trade receivable. So current assets give us an idea overall how much money does the company have in cash. Fixed assets are those which are expected to last longer than 1 year. So we have, of course, the machinery, the overall company. So fixed assets include company assets and overall their others, plant, equipment, land, cars. All those are examples of fixed assets. And fixed assets have also they also have the depreciation. So depreciation is the concept where the value of the equipment or for example, if you buy a car, the value of the car goes down. That loss in value is known as depreciation, and companies can use that as an expense. So this is all those things will be valued in the fixed asset. So liability, we said two types. There's current liabilities, which are expected to be paid off in 1 year, right? And trade payables. So any money, so if the company has bought raw material and they still need to pay for that raw material and they haven't paid for it yet. So, and they have to pay for that within the year, it's a current liability. Long-term liability are like bonds and other items which they have bought and which they have got from a loan from a bank, but they don't need to pay it off this year. They can pay after 2, 3, 5 years. That is a long-term liability for the company. The shareholders' equity is the amount contributed to the company by the shareholders over the life of the company. So that is the shareholders' equity. And this, as we mentioned, is equal to, so there's three things. There's common share equity, preferred share equity, and retained earnings. What is common share? Obviously, the company, if it is a corporation, so it has issued common shares. Money they got from the common shares, that is a common share equity. Money they got from preferred shares is preferred share equity. Retained earnings is their company savings. For example, think of it like the savings account for the company, what they have saved up over the years, that is retained earnings. So these are the things which are in the statement of financial position. So any question about the statement of financial position? Is that clear about these different things in the statement? Yes, any question?
Oh, good.
Okay. So then, so what is statement of comprehensive income? So the income is going to show, of course, what are all the expenses and what are all the, so what are the revenues? So revenues, what is the income coming for the company from the sales? That is revenue. And we're going to minus the expenses. And that difference is the profit, obviously. So in this, what we're doing is we are saying, what is the gross profit? That is the sales revenue or cost that were incurred to produce or acquire the goods that were sold. And then there's net profits. So let's take a look. Yeah, let's take a look at this example here. So in the example, this is from the book. So 1 million, the company had revenue. We're going to minus the cost of sales. Cost of sales is direct product cost. Think of it as factory cost. For example, cost of raw material, cost of labor, cost of electricity, um, gas, all those things which are input to the product, those are the cost of sales. So they're left with 400,000. Then there's general admin costs. These are for the accounting people, the marketing people, the other, well, marketing's coming under selling expense, but actually administration, human resources, top management, extra administration, all that other expense is 200,000. And selling expense is your marketing and sales expense. And then depreciation, this is coming from your fixed asset that you bought, the machinery, and the value of the machinery went down. So that's an expense for the company. So really, in the depreciation, you didn't really pay that money out of your pocket, but it is taken here as an expense for the company. And then the company had to pay interest on their loan, $20,000, and they had to pay $50,000 taxes. So when you um, So all this is 345,000. If you add this up, this is total expenses are 345,000. So from this 400,000, we're going to minus these other expenses. 400 minus 345, so we're left with $55,000 profit. Right? Clear? Does that make sense? So we just need to split it out that way. So the next one is changes in equity. So in the changes in equity, this is what are the changes overall in the statement. So this shows us, it gives us a good idea. If the company made a profit, we're going to add the money to the retained earnings. If they made a loss, we're going to minus it. So the changes in equity gives us a good idea if the company has done a good overall performance or not. So for example, if it was 175,000, this was the retained earnings at the start of the year, and we add $55,000 profit to it because we got $55,000 this year, right? If we add that money, and then the company paid out $30,000 dividends. So they have preferred shares, they have common shares, they have to pay out dividend. They paid out 30,000 dividend. So $200,000 is your retained earnings in this case. So it means overall from 175, the retained earnings went up to 200,000. So it's good. If the retained earnings went up, it means the company has done a good job of increasing the value for the company. So retained earnings, so this is the profit over the years that have not been paid out to the shareholders as dividends. If there was a loss here, we're going to do minus. We're going to minus the profit. Suppose it was a $100,000 loss. From 175, it went down to 75,000. So that means the company has not done good overall, right? So statement of changes in equity, that gives us a good idea overall how the company is doing. So we also need to look at the auditor's report. Auditor's report gives us an idea overall how the company is doing. The auditor is an independent company that comes and checks the company statements and everything, and they want to make sure that all of this information is valid and it makes sense, and they verify the inventory value and other stuff like that, right? So the auditor's report comes there. Okay, so I want to also show you before we go there. Let me show you in the text also a few things, so you can see my text, right? So this is the chapter we're talking about. So in the statements, we said that there are these statement: comprehensive income, changes in equity, and cash flow, right? Financial position, assets we talked about. They have cash and inventory and trade receivable. So 120 is their current assets, and they have plant equipment worth 400,000. Liability, they have to pay in this year $20,000 to trades, 40,000 notes payable, accrued charges. So they have to pay $80,000 liabilities this year, and long-term liabilities are also there. And so the shareholders' equity They're saying common shares, they have 100,000 outstanding shares. So 40,000 they got from there, and retained earnings 200,000. So this is shareholders' equity is mainly shares, money they got from the shares, and retained earnings. So the retained earnings is 240,000. So in the statement of comprehensive income, we said this is, I showed you already, million minus that 600 minus this 345, so left with 55,000. And the same thing, the changes in statement of equity we mentioned, they had 175,000 at the start, plus the profit, minus the dividends, so they're left with 200,000. So it shows that it's good. It's a positive thing. Clear? So is that okay?
Yes.
Okay. And then the next section is about the ratio analysis. The ratio analysis only you can understand if you understand about the statements. Ratios, we want to compare overall one company to another company. We look at the ratios. We look at how good the overall company is working in terms of the ratio. So there's liquidity ratio, risk analysis ratio, operating performance ratio, value ratio. So these are important ratios to understand a company's performance. So some of these, like you need to keep in mind, but from the names, it's easy to remember also. Um, Current ratio. So current ratio obviously is going to use current. So current assets and current liabilities. What are we saying? Current assets, what are those? Those are how much money does the company have cash uh, this year available, right? So that is current assets. And that includes the inventory, the sales, the value of the inventory, the cash, the retained earnings. That is the current assets. How much do they have to pay in the 1 year? So obviously, if we want to have enough money available to pay the liabilities in a year, right? So here, usually, if it's 2 to 1, they say it's a good ratio. If they have $200,000 assets, 100,000 liabilities is okay. Like they're covering it up to 2 times. So this is the current ratio. Quick ratio. Now in the current ratio, we have inventory. We're assuming all the inventory is going to be sold. What is inventory? Finished product. So you have finished product in the market, and if that is available, the finished product, if you can't sell that finished product, do you still have enough money? So the quick ratio, we minus the inventory from the calculation, and that will give us current assets minus inventory divided by, again, the liabilities should be current liabilities. This should be 1 to 1. If you have $100,000 at the top here, you should have 100,000 here. So then at least you're covering your liability. If you don't have enough of that, you could not. If you don't sell any inventory, then you could be in trouble. So this is quick ratio. Debt equity ratio, obviously from the name debt divided by equity, you want to total up all the debt. So the debt includes short term and long term. There's 2 types of debts. Short term is debt due this year, and long term is and then divided by equity. So it's saying, does the company have enough value to pay off the debt? So that is the debt equity ratio. And obviously, it should be like, lower is good. You don't want them to have a lot of debt compared to the equity. Cash flow from operations. Obviously, cash flow, how much money is it coming in for the company based on their overall company performance divided by the total debt. So this is obviously from the name, you can see this is going to be this ratio here. Return on equity, ROE, how much profit are they getting divided by the equity? So if they're making a million profit and their equity is 2 million, so we can see how much ratio they have for the profit divided by equity. So profit, we mean after paying all the taxes, after paying the interest and the dividends, that is the net profit. Earnings per common share, again, earnings is the profit. So profit, how much they made, divided by number of common shares outstanding. So how many shares have the people bought from their from the business? So that is the how many shares are already bought by the investors. So the profit divided by that number will give us the EPS, or earnings per share. So the purpose of doing this calculation is when you're comparing one company to another, you want to compare the ratios. So the ratios gives us an idea which one is a better investment. Then you have the dividend yield. So dividend yield is how much dividend are you earning, right? So are you getting per share divided by the market price. So in that worksheet also had this as a question, so I didn't want to do that yet because we didn't cover it. So this is the dividend yield, annual dividend. So what is the dividend you're getting per share? For example, we're getting $1 or $2 per share. That is your annual dividend divided by what is the price of the common share. So the common share price is $20 or $30. That is our dividend yield. Price earnings ratio is what is the current market price of the shares. If they're $20 in the market, and what is the EPS, you divide that, and that is your PE ratio. Inventory turnover ratio, cost of sales divided by inventory. How much is your expenses for all the factory costs divided by inventory. Interest coverage, how much are the earnings before interest and taxes, and divided by total interest charges. So this is saying, do we have enough money coming in to pay for the interest? Because if they don't pay for the interest, then there could be financial issue. And then gross profit margin, what is my income for the company minus the cost of sales divided by revenue. And then the net profit margin is equal to profit divided by revenue. So these, the ratios, I think you just have to like basically remember them a little bit from the names. Usually they will give you the figures, you just have to plug in the numbers. So example here, they gave you like EPS for a company is $2 and the price is 20. Here EPS is $1 and price is $10. If you want to see which one is a better company, you may think, oh, this is cheaper, $10, I'm going to buy this. But the earnings of this company are lower per share than this one. So if you do the PE ratio, price is $20 for this divided by 2, that comes out to be ratio is 10. And then the PE ratio here, if it is 10, and you divide that by 1, you get also 10. So although the EPS you see is twice, but the shares value is also 20. So basically it means these both companies for investment are similar, and they are selling at 10 times their earning. So so that's why we do these ratios. So this is one example of the PE ratio. Yeah, let's just do this and then we can take a break. So trend analysis, we want to see overall what is the trend, what is the change in our in the company overall, so internally and externally. So internally, we want to see over time what is the company doing over time, or externally you want to compare the ratios with an other company over time. So let's compare here. They're comparing there's two pulp and paper companies, A, and in this company, okay, we don't have the second one. Okay, so in this company A, we're looking at the EPS. Year one, it was 1.18, then 1.32, 1.73. So overall, we can see it's going up, which is good, right? But we can see here, so the ratios we do for trend is, here we're just going to do 118 divided by 118, we get 100. If you do 1.32 now here and divide it by 1.18, you divide it by the original base here, you're going to get 112. This means that our year two actually went up by 12%. And here also 1.73, and we divide it by 1.18, and then you will get 147. So this means this went up 47% as compared to year one. Same way you would do for each of these. And now we get a trend chart, and you can put this on a graph, and it will show overall how much EPS has increased over time, right? And so this will give us an idea, the trend analysis. We don't want to see just 1 year, we want to see Is the trend, is it increasing? Is it decreasing? Is it stable? So we want to see the changes usually over 5 years. This could be for one company, or you can do one company and compare it with another company. So that's the purpose of the trend analysis. Is that clear? Okay, let's take a 5-6 minute break, and then we'll continue. Is that okay, guys?
Yeah.
Okay.
Yeah. Mhm.